Both closed units and volume dropped another 2% in August as summer came to an end and kiddos returned to school. Closed to list inched down to 99.46%, as a majority of sellers found themselves negotiating to get their home under contract. And anticipating the seasonal slowdown approaching, additional sellers put a few more listings on the market, but ultimately remained 20 to 30% behind the previous 4 years. A lack of choices did not sway buyers from burning daylight viewing more homes before making a decision, as days in the MLS popped up substantially. But what caused the 6% drop in mortgage purchase applications in August? Was it the jump in 30-year fixed mortgage rates to 7.5%? Or that everyone who wanted to buy already has? On the economic front, a Sunday stroll of a slowdown is also happening. Talks of a swift hard landing to a soft landing to no landing now return to hopes of a soft landing after all, as the August unemployment rate surprised the markets by jumping from 3.5% to 3.8%. It's worthy to note that a move up of 0.5% in unemployment from the bottom has historically been a spot-on indicator of a recession. But this time, is anyone sure? The big reason for the move up was adults over 16 years old are coming back to work, or at least they're looking for jobs actively, as the labor participation rate increased 0.2%. Not a huge surprise. I mean, as you think about it, credit card debt rose above $1 trillion in August, student loan interest resumes September 1st, and the excess stimulus savings will be depleted by the end of September. The BLS jobs report came out with an overestimated 187,000 new jobs created. But then June and July got revised down by 110,000 jobs. All in all, confirming the pace of hiring continued to cool during the summer and into August. Hourly wages were also softening as job switchers are no longer being swooned away from their current jobs for bigger paychecks, and job stayers are faced with quiet cutting. Quiet cutting is a new phenomenon where companies eliminate a role only to reassign the employee to a lower position for less money. Additionally, the JOLTS report showed a significant drop in open jobs, closing 800,000 open positions. So fewer job options just as more people are returning to the job market. This job market softening will begin to slow consumer spending, which, as we know, is the tipping point for a slower economy, lower inflation, and lower mortgage rates. Not quite yet, but soon. I mean, consumer spending actually increased from 0.5% to 0.8% in August. Some want to chalk it up to Barbenheimer or Taylor Swift, but in reality, it was housing, investment services, food, and recreational items that drove up the increase. A little more spending, a little less savings. Savings rate dropped to 3.5% compared to the historical average rate of 8.8%. Bad news is good news, sometimes, as we watch a resilient economy show off its cracks. The Federal Reserve is set to meet again on September 20th, and all ears will be on Fed Chair Powell's comments. But few, if any, believe another Fed rate hike is in store for September. And only 35% of people now believe the Fed rate will raise in November. So the question is less about how high will the Fed go, but how long will they hold? Time will tell. I mean, as Powell says, we need to see 2% core inflation and a period of below-trend economic growth in addition to the softening of the labor market. So what happens to rates and our affordability in the meantime? Well, they're hinging on the job report and inflation. Mortgage rates dropped from 7.5% back to 7% on fewer job openings and a revised lower quarter two GDP. Interestingly, we didn't see rates rise back up with a higher annual PCE inflation since the market understood it was more math than anything else. When both the CPI and PCE are released next, they're going to be replacing a high 0.6% month-over-month number from August 2022, giving us a quiet little hope that rates may wane further. Notwithstanding global impacts like the Russia-Ukraine war or bank failures that kept rates from dropping earlier this year as we projected. I do need to point out, though, that the U.S. government is expected to run out of money and shut down on October 1st if Congress does not pass the 12 appropriations bill needed to sustain funding for the new fiscal year. That might be a little heavy for today. I get that. But here's the bottom line. The road is not straight. And per Jay Powell, the mission is not complete. So in the meantime, we have a choice to be fearful and negative or charge into the uncertainty with strategy and passion, to break down the fear with education and empathy, and to face winter and plan for spring. This is where market winners and financial futures are made. Well, that's a wrap. Until next time, this is Nicole Rueth with the Rueth team. It's my pleasure to keep you updated.